Hey everyone, welcome back to another dividend investing video. As we build our portfolio, sometimes we decide it's time to part ways with one or more of our investments. Maybe our investing thesis has changed. Maybe our faith in the company has changed. Maybe we made some money and want to take some profits. Or perhaps as you grow your portfolio, you look at some positions and ask yourself, why the hell did I buy this? Right now, I have a few in my own portfolio that I'm thinking of selling out of. In today's video, I'll show you what stocks I'm talking about, why that is. This portfolio being about 16 months old, growing nicely, it's in a good place to make some moves in order for things to grow more in the direction that I would like to do that. So this is today's video will focus on. Let's dive in. I'm Nick, and this is the Dividend Growth Income Channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. Real quick, we're a few weeks into 2023, so let's check in on my 52-week investing challenges. Of course, I make this spreadsheet available to you all. Link in the description of the video on how to use this spreadsheet. Just watch that video. Every Monday, I'm buying one share of SCHD in the Roth IRA. Each time so far, I've been buying it around that $76 mark. Performance so far is pretty flat. This has built about $8 additional in dividend income annually to this account so far. Then on Fridays, I'm buying a weekly share of SPLG, and this is a low-cost, low-share price S&P 500 index ETF. So I got my 3 shares of that so far as well, up 1.62% on that. So this is also being purchased in my Roth IRA. The majority of my Roth IRA purchases for 2024 will be these ETFs. Okay, now on to my YouTube portfolio, taxable. Here is the portfolio today as it stands. It's just a hair above the $20,000 value mark, quite a few positions. And in fact, some of you have told me you think I hold too many positions for a small growing portfolio in this early stage. And I generally agree that the more stocks you add, the more your portfolio starts to resemble an index. And on one hand, as a dividend growth portfolio, I do like having a lot of companies paying out. And as someone who dollar cost averages into positions every week, when I have more positions in the portfolio, it's just a wider pool to choose from and be selective where I see opportunity. And when I review these, a question I'm asking myself, call it my 2024 dividend investing resolution, is, am I owning this stock for anything other than the dividend it pays? And if the answer to that question is no, I don't believe the company deserves the long-term position in this portfolio. That's not to say the dividend isn't a factor for these stocks, because they are, but if that's the only reason, then at this stage of the game, I need to reconsider, because this portfolio has years and years before it's going to be paying me the kind of income I need to pay my bills, and I want to get out of some of the higher yielding, really dead money investments. The top 3 positions in this portfolio are ETFs. They're 2 dividend-focused ETFs with SCHD and VYM, and then an S&P 500 index. That makes about 25% of the portfolio, and then the rest of it are these 26 individual positions. Let's take a closer look at the 5 lowest weighted positions, because as I'm building this up, I've been focused heavier on some positions and less on others, and so I think it makes sense to check on, where are we lacking right now. So the smallest position in the fund right now is AT&T, ticker T. I have 14.175 shares worth about $235, down about 10%, about $26 overall. The position has paid me about $12 in dividends so far, and I'm due to receive another few dollars in dividends here in a few weeks. Shares are yielding 6.7% right now. Heavy dividend, low growth, and only having $200 in some stock like this is just not really worth it. I need to either double down on AT&T or move on. Okay, then the second lowest weighted position is MasterCard, ticker MA. It's a small position right now because, well, it's my newest position. I wanted to add something with more higher growth in the portfolio in 2024, and MasterCard does fit that bill nicely. But that's why it's at such a low weight, because I've only been buying it in the year 2024 so far. Now, shares are yielding 0.62%. Not much yield there, but a ton more to like beyond that dividend yield. And that's really another topic for another video. My third smallest position is Kinder Morgan Inc., ticker KMI. This is an oil and gas pipeline company that pays a hefty dividend yielding about 6.5%. Performance-wise, the investment is pretty much flat. I have over 20 shares of this one. It's yielding 6.4%. Hefty dividend, but no growth. Not a particularly exciting investment, but not necessarily a bad one, right? My fourth smallest position is Best Buy, ticker BBY. This is the consumer electronics retail chain, yielding over 5%. They have surprisingly strong dividend growth metrics. Right now I have about 5.3 shares of BBY, down about 4.5%. Then my fifth smallest position is Snap-on Inc., ticker SNA. They're a machinery and tool company, and I have 1.453 shares, up about 15% on this investment, and shares are yielding 2.6%. I only hold $413 worth approximately, while every other position in the portfolio exceeds $500. These are 5 stocks that I have less than $500 wrapped up in. And at this point in a portfolio valued at 20 grand, it caused me to ask, what am I doing here? When I look at this group of 5 stocks, there are really only 2 I truly see myself wanting to hold on to for the next 10 years. And that's how I want to think about these investments 10 years ahead and beyond. MasterCard, obviously, because this is a new position for this portfolio, but the other stock I definitely want to keep out of this group is Snap-on. It's just one of my better performers, and I've been focused on maybe where I saw some more value, but this is an extremely high-quality dividend growth investment. So the 3 stocks I'm thinking of cutting ties with are AT&T, Kinder Morgan, and Best Buy. Selling these 3 stocks would definitely cut down my forward annual income by a good bit because they're all heavy yielders, but I don't see that as a bad thing necessarily, getting lower yield for better dividend growth and really overall total growth. Because if I sold these 3 today, I think MasterCard and Snap-on would be the perfect place to move those funds. It would take these 2 stocks that I am very bullish on long term for the next decade up into my core positions, and then eliminate some of these investments where my confidence isn't so strong and really they're just kind of dead money investments. So I'm going to quickly go over why I want to sell these 3. So I'll go from most likely to sell to least likely. I'll give you my rationale. Now, most likely, I am going to be selling out of AT&T here in the near future. Look, after they slashed their dividend 2 years ago, the payment amount hasn't nudged a bit. No dividend growth at all. This is a dividend growth portfolio. And while some of these metrics are better, like the payout ratio is lower, there's so much about this business trending in the wrong direction. Like shares outstanding have been on the rise while revenue has been on the decline. Return on equity and return on invested capital both leave a lot to be desired. Consistently high debt. Shares of AT&T are down 34% from 10 years ago. I only bought this stock for the dividend, and that was a mistake. So I'm going to be selling AT&T here in the coming weeks, likely moving the funds into something like MasterCard, going from a 6% yield to a 0.6% yield, but I think my overall investment will do much better there. Okay, the next most likely to go is Best Buy, ticker BBY. I actually love their stores. Their dividend growth track record is surprisingly impressive. And the fact they've kept doing what they've been doing, seriously amazing in the era of Amazon. And I think there's value in being able to go to a Best Buy if you want to buy a big screen TV or refrigerator. You want to see it in person first. Best Buy is a fantastic place to do so. But I have questions on where this business would be in 10 more years. Perhaps it'll still be going strong and I'll be proven wrong, but I have other retailers in this portfolio that I like a lot more, specifically Kroger and Home Depot. Really, I think Home Depot is a very similar kind of profile company to Best Buy, but in a much stronger long-term position. So I should just be focused there, I think. Now, their score is recently downgraded at Simply Safe Dividends back in November. Still, they have a safe rating of 70. Their dividend growth is, like I said, surprisingly strong, although their last raise back last March was a smaller 4.5%. This is why I was attracted to Best Buy, but again, I think having Home Depot and Kroger already in the portfolio kind of makes this a little bit redundant. Maybe, right? Shares are yielding 5%, way above average, so this could be a great time to scoop up shares if you are bullish on Best Buy. But there's kind of some signs of trouble, I think. Their payout ratios are elevated. EPS and free cash flow per share have been dropping. I do not think this is a company that's going to be in a position to do a huge dividend raise, or when they announce their raise in March, was they'd be expected to. They do have a lot of good stuff. There's lots of share buybacks. Sales are trending in the wrong direction recently. Is it a blip, or is this the direction things are going to continue to go? Return on equity, return on invested capital look good. This isn't like AT&T where it just looks like garbage, right? There's a lot to like here. Margins are low, pretty normal for retailer, but shares are up 190% over the last 10 years. It's been a decent investment, could continue to do well, but I'm just not super excited for the future of this kind of company. As I sit here looking to trim my number of positions, getting out of Best Buy and moving this money into something like Snap-on or MasterCard or Home Depot, I would see that as like a wiser long-term decision. And then finally, I could end up selling out of Kinder Morgan here in the next few months. I think there is merit to having some stocks that pay higher yields, because I do have like Vici Properties, Agri Realty, and Main Street Capital. It kind of covers those bases. But in those three companies, I see a lot more potential total growth in the future. In the next 10 years, whereas Kinder Morgan is basically a dead money investment that I'm only owning for this dividend. I could justify owning those other three companies without the dividend. Shares are down over 50% over the last 10 years in Kinder Morgan. Just looking at this, I see no promise of returning to those glory days of 2014. There could be merit to continuing to hold this one if I was actively using income in this portfolio, but with the current mission focused on dividend growth and total growth, my lack of focus on KMI in this portfolio so far, because really like AT&T, this really has no business being in a portfolio calling itself a dividend growth portfolio. As it's faced dividend cuts and very lackluster growth since then, never returning to those 2014 highs. So this isn't a bad stock, but it's just not for me at this time. So selling out of these three stocks today, this would reduce my forward annual income in the portfolio by $58.44, but would also free up about $1,000 that could be put into stocks like MasterCard or Snap-on, elevating those two stocks into my core positions. And I think these are long-term winners. And then I'd also be removing some of what I see as either dead money investments. In the case of Best Buy, it's more I kind of see redundant. You kind of question their ability to continue growing like they had been. Total growth and dividend growth over dividend yield is what I am after, okay? So those are the thoughts I have for this. What do you think? I do thank you for watching. Please leave a comment letting me know your thoughts. I did recently put out a video addressing some of your recent comments and questions, and you can click right into that here to see those. Maybe I'll include yours in the next one. Thanks for watching, guys, and keep investing.